shoe company, and this is our investor presentation for our investors. My name is Alex Gonzalez.
My name is Nabeelansary.
I'm Dan Justin Sevillano.
I'm Amber Joy Figueregan.
And I'm Raul Estrada.
All right, so to kick it off, we're going to look at basically our company efforts through each market. So our plan in each market was to start everything basically as new to rebuild the company. We wanted to start with a low retail price and SQ rating in both the internet and wholesale markets, which you can see on the chart here. As we began to grow in the US, we steadily increased our retail price until year 13, where we then kept it relatively around $90 to $93 per pair, ending year 20 at $94 a pair. So kind of keeping that higher end for our sneakers. We also wanted to increase our SQ rating until we reached a comfortable 7.5 to showcase that we are in that middle ground when it comes to luxury. We wanted to hone in on the internet segment to make it easier to get pairs in people's hands, and we can see that in the amount of pairs sold in the wholesale market compared to the internet segment each year. We left the wholesale price around 60% of the retail price. That's to offer our retailers a nice percentage of profit if they were to price at our retail price or something higher. As we move on, we can see the same trends hold through in the Europe and Africa market. We still wanted to maintain that wholesale focused driving of sales, as well as kind of leaving model availability to not super available, kind of keeping it a little bit more limited to kind of drive more demand for our product. Continuing to the Asia Pacific market, year to year our trends hold true as compared to North America and Europe and Africa. One thing we did want to focus on in the Asia market is give them a little bit more availability. This is because the demand is going to be a bit higher compared to the previous two markets, just based off the sheer population that Asia has. And lastly, in the Latin America market, again, trends were similar, selling to the wholesale market around 60%. We had a slightly higher retail price here due to the lower production in this market that Amber will touch on later.
For the income statement, we focused on our internet sales more than our wholesale prices. That's because, like Alex said, our wholesale prices were 60% of our retail prices. So focusing more on internet sales brought in a higher profit margin. Our wholesale prices were still pretty high. Our wholesales were pretty high. We still focused on wholesale because it's easier to sell in bulk, but our main focus was internet sales, and we were on top of internet marketing, actually. Marketing expenses were pretty high compared to every other group. Not the highest, but more in the upper middle ground, while our warehouse expenses were more in the middle. We believed that if we marketed more towards our internet sales, we'd produce a higher net profit, and our strategy worked pretty well as we were second in the net profit aspect of the game.
As you see in the figure above, this is our balance sheet, which consists of our assets, liabilities, and stockholder equity accounts at the end of year 20. At the end of year 20, we had the most amount of cash on hand compared to any other company at year 20. We also had the second most current assets, right under company D, as shown above. In total, we had the second most total assets compared to our competitors, and we had a below average current liabilities and absolutely no long-term loans. At the end of year 20, we ended with an excellent debt to asset ratio of just below 3%. With this debt to asset ratio and the amount of cash we have on hand, financing and investing in new opportunities should not be an issue at all. Moving forward now to our equity section of the balance sheet, we ended with the third highest retained earnings compared to all of our competitors. We also backed stocks as treasury, which reduced our equity debt. At the end of year 20, we ended with an equity account of just about $1 million, which just one other company was able to achieve.
So moving on to earnings per share and return on equity, we wanted to gradually increase earnings per share every couple of years. Our objective for the first 5 years was to increase EPS by 50 cents. We started off with low scores in the first 2 years, but by year 15, we were able to obtain the highest EPS at $8.88. And afterwards, we increased EPS further by $1 each year in years 16, 17, and 18. maintaining our position of having high EPS scores. And for the last 2 years, we increased EPS by $1.50 each year for years 19 and 20, ending with a total of $20.37 per share. Overall, our team maintained having the highest weight average over all other groups for earnings per share. And moving forward to return on equity, we wanted to begin with increasing average ROE by 1% for each year for the first 4 years, and then increase average ROE by 1.25% each year for the remaining 6 years, ending with an ROE of 29.6% by year 20. And with that, we established being one of the teams with the highest weight average for return on equity as well.
So for credit and image rating, our main focus was to get our credit rating on top at the beginning. So from year 11 through 13, our main goal was to get from A to A+, and we achieved that by year 13. And then we started focusing more on our image rating, which was at 80 at the time, a little over 80. And we focused on getting it over 90, and we achieved that by year 16 when it hit 90. And it kept going up to 91, 92, and 93 in the following 3 years. In year 20, we went back down to 89, which was unfortunate, but for a 3-year average for the last 3 years, it was still above 90, so we were content with that. Our main focus was still our credit rating, because if you keep your credit rating at the maximum, you get more investors, and that's our most important goal. While our image rating, as long as it was around the A range, we were okay with that.
Okay, so moving on to branded operations, and this is more of a retrospective on the last 10 years for our internet and wholesale segments. We decided that for about the first 5 years we had the company, we wanted to work up the SQ rating in about the same rate in all 4 regions we were operating in. Towards about year 15, 16, we were heading towards a SQ rating of 8.0, which is very above the average of about 6.5 during that year in all the other companies and regions. We only saw marginal results in our operating profit and our ROE in that year over having a 7.3 rating in year 13. So we decided to wind it back down over the next 3 years after that to about a 7.7, and we decided to settle on a 7.5 SQ rating in year 20, which is the best rating of quality with the lowest amount of cost but highest revenues. So it had the best payoff for us. Pairs sold on the internet, we pushed over 1,000 pairs in North America, Asia Pacific, and Europe by year 18, and we never dipped below that in those regions after that. We did decide to have the lowest amounts of investment in the Latin America segment in terms of retailer support, but we felt that it wasn't worth the payoff to really gun for retailer support over there. But surprisingly, our operating profits were about the same in every region at that point in year 20, no matter our market share, the difference in market share with Latin America and the other 3, and no matter our advertising and marketing efforts. Our wholesale market shares have been over 10% in North America, Europe, Africa, and Asia Pacific, which we feel is very, very healthy market shares.
So moving forward to facility space and production equipment. With regards to facility space, our strategy was to focus on mainly maximizing plant capacity in North America and Asia Pacific for the first couple of years, and then slowly begin growth in Europe, Africa, and Latin America towards the last couple of years. By year 20, we were able to house up to 6,000 pairs of equipment in North America and Asia Pacific, and with the other 2 regions, we expanded those facilities to be able to house up to 3,000 and 1,000 pairs of equipment by year 20. And for expanding production equipment, we focused mainly on North America and Asia Pacific as well to obtain efficient production levels and to utilize all of our production capabilities, and then slowly include Europe, Africa, and Latin America into its expansion.
Okay, so moving on to celebrity endorsements. From talking with some other competitors, companies, and boards, we understood that most of our competitors didn't want to spend the money on celebrity endorsements. They didn't see the payoff in it compared to traditional marketing methods in brand advertising and retailer support. But we feel here at a big Red Shoe company that celebrity endorsements were the core to our success. It's how we've really gone ahead in the past 5 or so years. We never had less than 3 celebrities sponsored by us in a year over the past, I would say, 8 or 9 years that we've had the company. And we felt that this was very strategic over having maybe just 1 or 2 at a time or not at all. In terms of our offers, we were very strategic in assessing where other companies tend to place offers and keeping it as close as possible so we don't overbid and not have to spend excess money. And by the end of year 21, after 10 years here, we have the highest consumer appeal rating out of all 10 major competitors. And that really, really shows in our market shares in both internet and wholesale sales. And we feel that if we were able to hold this amount of consumer appeal in future endorsements and contracts, then we will be very much safe in a big red shoe.
Now, in regards to our stock price, we either met or exceeded our goal every single year except for year 12. For year 12, we ended with a stock price of $46, and our expectation was slightly higher at $50. We were in the top 3 in 8 consecutive years from year 13 to year 20, and we had the highest stock price in 5 of those 8 years. We also ended at year 20 with a stock price over 170% to our expected stock price.
And before we have a summary and wrap things up, we wanted to share with you why we feel like a big red shoe stands out compared to our other 9 major competitors in the world. Our main difference was our private label operations. We really decided from the get-go to put a focus onto this very hidden segment in the market that could be a lot less marketable and profitable than internet and wholesale operations. In year 10, when we first got our hands on the company, we decided to just test the waters out in the private label segment. We gave even production to all 4 regions of about 200 shoes and saw the results from there. We liked what we were seeing in Asia Pacific and North America, but Latin America and Europe, Africa were a bit harder to get through and to crack the market. So for the next 4 years after that, we were testing out the waters in all 4 regions. We were deciding on which regions to sell to depending on the existing supply that our other competitors were aiming for. Where one competitor wasn't, we decided to go there, and where we were making sure that other competitors would think twice before coming by. By year 16, when we decided to go full throttle on private label operations, we decided to exit the Latin America market mostly. We saw that out of the 4, it was the least profitable for us. It had the lowest margins, and we decided to put all of our production equipment and facility space towards North America, Europe, Africa, and Asia Pacific. And our margins have been very, very healthy the past 5 years, and it's made up about, I would say, 20% or so of our revenue, and we hope to keep it that way. And we put the financials here at the bottom of our last slide to put it all together. So in conclusion, our earnings per share increased by about 10-fold or 1,000% over the past 10 years, which was far beyond expectations. Our ROE is nearing about 30%, which also exceeds investor expectations, and we feel like it could be higher depending on future dividends and future profits. We did steady stock repurchases and dividends since about year 14 to help please our stockholders and to make the company more profitable, increase stock price, and to let go of excess equity, because by about year 17, 18, we were having a lot of excess equity, which we felt like could have been spent in our marketing or higher costs in improving our shoe to a higher SQ rating, but felt it was better to give it back to our stockholders. Our credit rating has stayed steady at about an A+ the past 7 years, and it hasn't dipped, which we're very glad about. And our image rating, while not the most competitive in the industry, we still feel it is very stellar at a decent 90 average. Our revenues never dipped below $1 million for the past 4 years. It's never wavered. They've constantly just been on the come up, even if one segment of our internet wholesale private label were to dip a bit, another would make up for it. And we decide, as we leave a big red shoe company onto a next executive board, we have $500,000 in cash ready for the next leaders we have to make future decisions. And no other company can boast about that. I really doubt it, depending on our marketing research. So we thank you so much for hearing out our pitch for a Big Red Shoe, and if you had any other questions, don't hesitate to let us know.
Thank you.
Thank you.
Thank you.